Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, Paul. Good to be here again.
Yeah, well, you look a lot browner actually now than I saw you a month ago. And big congrats on your prediction that the US Treasury would get through 2% because it's done that. Now, dusting off the crystal ball, what's your sort of outlook for the equities? And perhaps have a look at the top level at the FTSE and also obviously the small caps, because it seems as though energy and financials have managed to hold up well, but the rest of the market's had a bath, or my portfolio has.
It's and you're not alone in that, Paul. I mean, if you speak to a small or mid-cap fund manager at the moment, it's the old adage, tin hats on under the desk a bit. But and you quite correctly say, if you look at the top level, FTSE doesn't look too bad. It's outperforming globally. You got an article in the Financial Times today about inflows into UK equities. It all sounds really rosy, and the FTSE's up 2, 3, 4%, somewhere around that level. But of course, the money's going into banks, oils, commodities, miners, and that doesn't really favour small cap. So where a lot of our watchers are and listeners is in that small cap end of the market. And what's happened there is we've seen, as inflation just continues to surprise on the upside, that the huge moves we've seen in yields over the past, as short as 3 weeks, have really taken meant that the market become very risk averse.
Yeah, just on that, Jamie, on the yields, let's just split it between the UK yield curve and the US yield curve and what it's saying, because you've still got a steep, you haven't got a steep, but you've got an increasing yield, a normal yield curve in the US, but actually it's pretty much flat now as the proverbial pancake in the UK. And what that is telling us, and it's inverted at certain places, certainly at the very long end, and also between the 2s and the 8s. So how are you interpreting all this?
Well, basically that's telling us that the bond markets think that the Bank of England has potentially made a policy mistake, and that they are behind the curve, and that to catch up, they're going to have to raise rates more than they would like to, and that would have an impact on growth in the UK economy, and that if you look further out, those rates are going to have to come back again. So you've got this flat yield curve, which means that growth in the UK economy, if you believe what the curves are telling us at the moment, and personally, I think they've probably gone a little bit too far at the moment in terms of the number of rate rises that they're discounting, which we can maybe come on to in a minute, because you're talking about 6 or 7 in the UK and the US, which is pretty aggressive. It basically means they'll be raising rates at every meeting this year. Now we said before, they are behind the curve. The States, there is a bit of a steepness, but it's pretty flat in the States, to be honest, as well. And again, they're worried there that they've made a policy mistake. They're going to have to raise rates too much, that will then hit the growth in the economy and obviously hit companies and et cetera, et cetera. So that's what the bond yields are saying to us.
What about, I mean, I've heard people actually interpreted it such that we're going to get a recession the back end of this year.
Yeah, people are talking about 2023 slowdown / recession. Because the central banks are going to have to move so far and so fast that will have that impact on growth. So we don't see that. Let's be clear on that. We don't see that. I certainly think in 2022, the revenue line for companies is not going to be a problem. As we've spoken about before, margins are where the pressure is going to be because of input prices going up, wages, which obviously is the reaction if the price increases move into wages, that will squeeze margins as well. So it's the margin, it's the bottom line, the profits, the companies is the number you're going to have to look at. I don't see the revenue line. Well, let's be honest, if you've got 7% inflation, that's going to help your revenue line quite a bit, isn't it, in the year? So you've got quite a good start already, but it's that bottom line where on the margins where you're going to see the squeeze. But
it seems quite difficult to protect your margins because I mean, you had Unilever even, who's obviously an archetypal FMCG brand, and you'd expect them to, but they're seeing margins decrease for the next 2 years.
Yeah,
So,
well, they say 2 years to get it back. Yeah. I mean, Next said the same with their numbers. Remember, they got 2 price rises they're going to put through this year, once with the spring summer, and then a larger one of 6% with the with their autumn winter ranges. So prices are going to keep going up through this year. And I think we discussed this last time. I mean, if you look back a year, the central banks were saying they saw inflation within their range at 2%. And in the US, you've got 7.5%. And today in the UK, you've got 5.5%. And you've got the Bank of England across the road from me here saying that they think it's going to peak over 7%. So I think that is where the markets are at the moment. And that has had this disproportionate impact on the small cap end of the market, and particularly companies where, as we talked about before, long duration stocks, where the profits are further out in the future and the discount rate rises, then the value of those earnings today falls. So that's what we've seen. But I think on a more positive note, we can kind of move on to where do we see things getting better. I think that's what we need to look at now.
But
because
just before we move off that one, I mean, obviously a lot of listeners will be, if you're right and the market's got ahead of its skis in terms of rate height expectations, both here and the US, you must think then that the CPI is coming down to roughly around about 2%. So when do you expect that to happen, the policy levels? Because the market believes, I think, such that this year we're not going to see less than 4% because of energy and electricity.
I think it's probably higher than that. I think it's probably in the US. The market's at the most pessimistic kind of forecast level at the moment. It probably thinks that the US is not going to come back that 4.5, 5 or so, maybe 4 in the UK. But I don't think the absolute level is what we should concentrate on here. It's the delta that moves the markets. It's the rate of change that moves the markets. Now, inflation, CPI, is going to peak March, April, probably in the UK and the US. And then it will start to fall. Now, we don't know how fast it's going to fall. It might not be as far. It might be quite slow to fall. But once it starts falling and interest rates are being raised, I can see then that markets are going to be a lot more amenable to wanting to invest into small caps, growth stocks, but as a asset class, because it's the delta. They know rates are coming down. Sorry, rates are going up, but they can see CPI is falling. The fact that it's falling is the important thing. The fact that it's not going up anymore will be the important thing for the markets, at least to start with, and it will provide and it will provide more support for equities then at the small cap end because of that rate of change, that delta. It's reversed from going up to going down. And I think to do that, I really think that the Fed need to do 50 basis points on the 16th of March, just so they kind of buy themselves some breathing space then by doing that. If they do 50 then come April, May, we start to see CPI starting to roll over and come off. I think you see a much better environment then for markets overall globally.
And where do you think the Bank of England's going to be on the interest rates, not the 10-year yield, but where do you think that's going to be at the end of this year and next year then?
Well, I'm with you as we talked last time. Where should we think they should be now? Where should rates move to? Should probably be around 2%, let's be honest, around that level. I don't think they'll get there, to be honest, because if CPI starts falling,
well, that's a big if, that is. I mean, that's saying that Putin isn't going to invade Ukraine. And likewise, I mean, if you just put on basically our electricity and gas into the equation, that's why it peaks out at 7% because of the standard variable rate.
But then the annualization impact, it will start falling as we go into the summer. If it doesn't, we do have.
No, I get that.
But it will start falling, and the markets will look at that. And when it starts falling, dependent on that rate of fall, and that's the big unknown at the moment, to be honest. I mean, I don't know on that, and we'll have to kind of look at how things are moving over the months ahead as we move forward ahead, how the different components of inflation move. But once it starts falling, then the kind of pressure for the banks to move on rates will start to ease, even though they've probably only got them to what? Let's say the Bank of England does half next time, because it nearly did half last time. Let's say it is half next time. That gets us to where 1, doesn't it? So maybe we get to 1.5 in the UK. In the US, well, obviously they haven't raised rates yet, so they're only at a quarter now. Will they do a half? I don't believe they will do a half. So maybe in the States you get to less than that. Maybe you only get to 1 in the States before inflation has fallen far enough that that they kind of start to take the foot off that interest rate rise accelerator. But I do believe they do need to keep doing that because you do need. I mean, this whole thing. I think you need a positive carry on rates. You need that positive kind of yield curve out there, basically to incentivize investment, returns. We've had this era of free money. Well, that's certainly coming to an end. I mean, we've had it for almost a generation now of free money. That needs to come to an end, and we need to just normalize the high financial system. That's certainly what we believe here. And then, but yeah, I don't think rates get to where they probably should get to because of that whole thing about growth slowing. But we shouldn't forget, though, that Omicron coming to an end will be a stimulus for economies. The US economy, the UK economy, European economies, they've all been suppressed by Omicron of late. So that's now coming to an end. So, and actually it's quite a nice time for it to happen. Okay, it's not quite spring yet, but as Europe comes out, as the US comes out of Omicron, that will be an impetus to the consumer. So we've got that kind of, we've got an impetus to growth there coming through from Omicron coming to an end.
Okay, and then sort of like again, just polishing that crystal ball. I know I appreciate it's maybe a bit of an unfair question, but is Russia going to invade the Ukraine? What's your probability?
Yeah, this is very. It has to be an individual's personal view on this. Russian politics is all about a massive chip on their shoulder. Hopefully I'm not going to get assassinated for what I'm saying now, but anyway, but Russian politics is all about a massive chip on your shoulder. They always believe, it's belief that the rest of the world is out to get them. So what a Russian premier wants to be seen is to be strong within Russia. He needs to be seen that he is in charge. And let's be blunt, Putin has played an absolute blinder on this. He's got the second pipeline in there, which is quite amazing about how, the chief executive of the pipeline is an ex-Stasi spy. It's quite amazing. And Gerald Schroeder being on the Gazprom board, I mean, you couldn't make it up, could you? But anyway, that's by the by. But he's played a blinder because he's got the West exactly where he wants them. They're on planes flying to Moscow to meet him at the end of his 10-meter long table. And all those pictures will be played across the Russian press. And he looks like he's totally in charge of the West, because he's got us by the proverbials, I suppose, because he's sitting there going, well, I might invade, I might not invade. But in the meantime, we're kind of kowtowing to Russia and saying, well, what do you want? So he looks very strong in Russia, to cut to the chase. That's what he wants. So as long as that's the case, and he keeps keeping the pressure on and gets what he wants, I don't see why he invades. And there is a window on this as well, because he needs to invade while it's winter. Because he can move the tanks. They can move very quickly then when the ground's frozen. If you get into the spring, then he wouldn't want to go in then because of the change in the whole kind of whether he can do it. So I mean, it's actually an impossible question, will he or won't he? Now the caveat to all of that is maybe he's mad and wants to invade anyway. But we don't know that. But I don't think all that kudos he's gained with the Russian populace, he could lose if you have body bags coming back, to be really a bit horrible about it. But if he had body bags coming back, he could lose all that. And let's be honest, what else has he got out of this? He's got a great relationship now with China, so they've got a new power axis there between China and Russia. He's played a political blinder, to be fair. So he's got a lot out of it. Does he need to involve Ukraine? Well, that's such a kind of historic geopolitical of historic geopolitical importance to Russia, that it's an emotional decision probably at the end of the day as to whether they do want to go in. But if I had to say yes or no, I'd say no. I don't think he goes, because he doesn't need to now. He's got what he wants.
So with all these sort of relevant moving parts, we've got obviously fiscal, monetary, and we've got a bit of geopolitical tensions as well. And let's just assume you're a small mid-cap investor and your portfolio's been battered. What is the sort of like the best sort of general sort of advice or tip you would perhaps give people to want to stay sane in this market, and two, positioning their portfolio for the months ahead?
Well, I think you have to have in the back of your mind that interest rates are going up. So you don't want to be in indebted companies. I mean, that's one thing. It's obvious they're going to have. You don't want to be in companies that are going to have headwinds.
You just raised a brilliant point, and I was going to ask you later on, but given you've just done the great intro, can you talk to me about Studio Retail?
Oh, I knew you were going to ask me about that.
What happened about that? Because it's apologies to remind you, it is a Singers client, and but it came out with an absolute shocking statement at 7:30. I think it was on Monday. Saying that it was trying to raise £25 million and failed to do that, and the banks foreclosed it. So what's happened? Yeah.
Well, exactly that. I mean, for reasons that are not known as such, because it's between the banks and Studio at this stage, us, Mike Ashley, everybody, shareholders are amazed that the banks have decided not to advance to them. No, they probably didn't need full 25, but that would have given them some insurance to basically effectively a bridging loan, because the stock that they'd ordered arrived late. So it arrives after Christmas. After Christmas, you can't deliver it. People have cancelled orders. So they need time to basically monetize that stock. And to do that, they're up against the top of their existing banking facility. So they asked for some more. And for reasons that are not known publicly or to us at the moment, the bank decided, or the banks, sorry, there's three banks in the banking syndicate, and then there's one bank on the securitization of the credit book, desk book. Then they decided not to. So that's where we are.
You certainly raise a good point, don't you? If a company's indebted and with interest rates going up, the actual amenability of the banks to extending credit, and even perhaps shareholders extending credit as well, but we're doing a placing or something, is less than it was if the days of monetary sort of free for all have disappeared. So I think
I think it's watch this space on that one. I can't say any more than that at the moment because it's the shares are suspended. Let's see what happens in terms of support. You've got Mike Ashley there as a large shareholder. Obviously, people can read what was in the press over the last 48 hours as well to see what's been said there. Hopefully, the hope is that there's 1,000 employees here at this business. It's a 500 million turnover business. Hopefully, a solution is found.
Well, anyway, so coming back to
what we should look for.
Back to the checklist. So effectively, we've got the your portfolio's been battered, staying sane, and where best to go. You were rightly picked out. Don't go for heavily indebted companies because they might be in a tough challenge place there.
Yeah. Pricing power we've spoken about at length. Margins are going to come under pressure. Margins from peak levels. Don't forget they've been at peak levels, but it's the direction that counts. So margins are going to be under pressure both from unit prices, input prices, but also wages. I mean, wage demands, despite the Bank of England saying don't ask for a wage rise, people are going to be asked for a wage rise because their disposable income is being squeezed. So that's one point. So pricing power is key. I think where consumers are going to spend is going to change a bit. And last time we talked about being very positive on the holiday companies. And of course, Ukraine's had a little bit of a kind of blip on that, but that's a short term.
Yeah, I can't see that being a holiday destination.
No, you're not going to go to Ukraine, are you? But funnily, some people do, don't they? They like these kind of bench. Yeah, but anyway, not for me. So where are people going to spend? They've spent the last 2 years spending on goods. So they've been spending on whether it's for the house or buying a new house or a new kitchen, or whether it's electronics goods, TVs, whatever. They've been at home, they're spent on the goods. Now, we talked about the roaring 20s last year. Now they're spending on restaurants, leisure, pubs, and holidays. You've seen what TUI have been saying. Everyone, the airlines, everybody wants to go on holiday. And pricing, and they're willing to spend a lot of money to go on holiday as well. Because don't forget, a little bit different in the US, the savings have been spent quite a lot in the States. But in the UK, those savings are still there. So that's where, that's another thing. I think that's a good place to be. Leisure, holidays, if you get another fall off in the market because of Ukraine, assuming he hasn't invaded, of course, then that's your opportunity on the stocks that we've talked about before. It's your EasyJets, it's your Ryanair, it's your Wizz, and then it's TUI, it's On the Beach, it's companies like those are the companies to kind of look at there, because people are going to spend on holidays this year. You want to be in areas now where you're going to have increasing spending rather than areas that have already benefited strongly from COVID. So that's a good area. Other areas to look at. But
the issue there is that it's had a lot of wreckage, isn't it? So it's selecting those stocks with strong balance sheets to dovetail with yours, and where you have secular pricing power. So you have pinch
exactly. Yeah.
Because if you're just a bog standard holiday company without any real USP, yes, you might get a price spike this year, but frankly, it's coming off the following year.
Well, it could if you get the slowdown, yes. But we're looking for. The market has been hit hard in the mid and small caps, as we all know. It's looking for the opportunities within that, and what I'm trying to identify here, as you said, is where the opportunities are in a kind of a from a top down viewpoint. And I still believe that CapEx is going to be a big story. You had Renishaw reporting in between from our last meeting, and they said that there's going to be huge capital expenditure in the chip market, but also generally they see that continuing. So that really supports what I've been saying there in terms of CapEx, be it reshoring, nearshoring, as businesses don't want to rely on long supply chains. That's going to drive CapEx, because you're going to have plants to produce that stuff on a nearshore or onshore or nearshore. So I'm still supporter of those type of companies as well. Obviously, the miners, banks, if interest rates are going up, the banks are going to make more money. And at the small cap end, there's a few banks as well, like Arbuthnot and companies like that who can do well out of it. So those are the kind of areas that I think that you need to look at for where we can, where there's money to be made and to take advantage of this fall off in shares.
And if presumably with this sort of like saber rattling between Russia and the Ukraine, that's going to accelerate all things electric vehicle and clean energy, presumably, because it was always it had a bit of a rocket booster anyway, but actually it's made it far more important now to get off sort of like.
Well, you want to be self-sufficient, don't you? You want to be self-sufficient in energy if you can. So wind power, all that kind of stuff, EV. Storage, energy storage. Of course, you've got on the one side, you've got the positive drivers there. On the other side, you've got that these tend to be long duration stocks, i.e., it's quite some of the profits are quite a long way out in the future. So you've seen stocks like ITM hit hard because, there's lots of big orders coming in, but when's it going to drop to the bottom line? Items like that. So that's something we do need to be aware of on those stocks. So you just take a little bit of care, but for the long term, yeah, totally. Those are great areas to be in because they're growth industries. Secular growth is what you want. If you're in small and mid cap, you want to be in secular growth areas of the economy, global economy and UK economy, and that's what you want to do. And then on top of that, you can overlay the more shorter term cyclical trading opportunities, like we talked about there with leisure, holidays, spending on that, as people want to enjoy themselves after 2 years of being locked down.
Yeah. And what about sort of healthcare? Because, obviously that's got a lot of pricing power.
It's got to people have got to, the story is still there on that. Obviously, some of the COVID testing type companies have come under pressure because, we don't know.
All of them have.
Yeah, exactly. We don't know what's going to happen longer term in the testing side and what's going to happen. But I think, as we said, we think back to maybe even the first one we did of these. And I spoke about how my wife's Polish. If you go to Poland, then you've got a private industry of testing where you can even go on a Saturday morning and you get tested for whatever you want to get tested for. I really believe that that the UK is deficient in that, and you need to put that kind of infrastructure in because people want to know about their health. They want to be able to go and find out. They don't want to have to try and book an appointment at a GP surgery. And then the prices will come down, but the prices will come down from maybe private clinics at the moment charge exorbitant fees in the UK because there aren't many of them. But the prices will come down and people want to go and find out because people want to be healthier and they want to find out, And COVID's shown you that. So totally that. And we shouldn't forget that the hospitals have still got to catch up on that huge backlist of treatments that have been held up by COVID. So that's all still got to happen. But the market's been quite random about how it's hit share price. It's not random, but you know what I mean. It's hit everybody. Everybody's been hit. So within that, it's going to throw up some great opportunities. But it's kind of, are they going to go back up tomorrow? Maybe not. But you're not don't invest. If you're day trading, well, day trade. But we're not here today.
All right. Well, I'm going to ask another cheeky question just to close. In a month's time, when we chat and have an update, okay, is the market for small and mid caps going to be up or down compared to where we are now? Because we've got a lot of moving parts in between.
With my comment on when inflation is going to start falling, the problem is with the Bank of England. I think, what date is it today? So it's the 16th. So if we speak, it'll be the day before, won't it? The MPC meeting.
Yes.
So the market's going to be wondering whether they're going to raise or not raise, whether they're going to do 25 or 50. If the market believes they're going to do 50, the market should be equity. I think the market should be up, because what bond markets and financial markets in general want to see at the moment is they want to see that the banks catch up with where we are on inflation. They're more worried by that, I think, than worried about they're going to stay behind the curve and then have to do too much. So if they can do something early while you've still got good growth, and I think 2022 the top line is going to be fine. If they do it early, then that removes that pressure to have to do something late and cause damage to the economy. So that's going to be the key. So if the market believes it's going to be up by 50 basis points, small caps will be rallying.
Okay, right. Well, I look forward in actually seeing what happens then. So we'll have to monitor that one over the next month. So thanks again, Jamie, and appreciate all your insights, and looking forward to touching base again on probably the 16th, 17th of next month.
Thanks, Paul. Great to chat.
Take care.